All right. Good morning, everybody. We're going to go ahead and get started. Let everybody continue up the conversations, everything. Thank you so much for coming out here. Today is Thursday, January 9th, 2025. Welcome to this month's Capital Markets Update and Outlook. This is a special monthly update for you as we, of course, are delivering our 2025 outlook, kind of trying to look into the future of what's ahead here this new year. We are live on our website, as well as all of our different social media pages. So for all of you guys who are online, we appreciate you taking the time to be with us here today, even though you can't be with us here in the room. If you're watching in the recording as well, I want to also welcome you and thank you for taking some time out of your busy schedule. If you are joining us for the very first time, my name is Eric Hagan. I am a financial advisor. I am president of Capital Consulting Group, or CCG. CCG consists of myself, of our Chief Investment Officer, Tom Fox, who we're going to hear from in just a couple of minutes. We also have financial advisors Dan Oshman and Rana Grant, and then our client support team, Josh Denny. Josh just joined us a couple of months ago. So for those of you in the room, if you have a chance, introduce yourself, say hello, and welcome him to the team. We're so excited that he is here with us. Josh, raise your hand over there real quick so everybody can see which one I'm talking about. Awesome. And then, of course, John Knutson, who many of you know, and then Marilyn Westmark makes the team here. Our goal altogether is to help individuals, couples, and families make their next financial decision, and then the one after that, a good one. We deliver on this through both our fiduciary investment management solutions and our personal financial planning. So whether you have questions about retirement, tax planning, legal or estate planning, or insurance planning, we can help in all of those areas. And I think almost most importantly is we can help put all of those different pieces together for you. All right, so today we are going to hear from Tom Fox. Tom is going to review the positives in the markets, the headwinds, and give us his outlook for the rest of this year. Ultimately, this is kind of your opportunity to look over our shoulder, get an idea for what we're seeing and what we think it means for the future. So I encourage you, particularly those of you in the room, if you have questions, maybe jot them down real quick, store them in your memory. I will open it up for some Q&A at the end. If you are watching with us live online right now, I will be watching and monitoring the comments section wherever it is that you're watching. So you can post a question right in the comments section. I will get those to Tom at the end. And then, of course, if you're watching in the recording, you're also invited to post those questions in the comments section, or just reach out to us directly. We'd love to field those questions for you and get some answers for you. So again, do not hesitate. We love taking your questions. Tom spends all of his time more behind the scenes, doing market research, due diligence, really focusing all of his time on the economy and the markets. Tom has over 35 years experience, a very long resume, as you can see here on the screen. We are just privileged to have him as part of the team. With that, I'm going to bring up our theme for 2025. Surprise, surprise. Our theme continues for 2025. The times, they are a-changing. So with that, if we could get a little round of applause for Tom here. Welcome, Tom.
All right. Good morning. Am I amplified?
You are if you grab that.
Okay.
But I think, can everybody hear Tom? Okay?
You could hear me, right? All right. So I'm excited to bring this year's forecast. And we're going to talk about last year. We're going to talk about how difficult it was last year. And then we're going to look at where we think things are going. So let's move on. I'm going to try to use this if I can. All right. Got it. Okay. Here are the main themes for what is the current wall of worry that's out there today in the markets. Well, number one is valuation concerns. And we're going to look at a chart on this, and it will describe and show in detail how high the stock market valuations are currently and what impact that might have going forward. The second thing is the slowing economic momentum. We're expecting, and we're not alone in this, that the economy will start to cool. Now, there's no evidence today that there will be a recession at this time. The consumer has been incredibly resilient, spending, and the economy did much better last year than most people expected. So we're going to take a look at that. We got a chart on that. And then also policy uncertainties. We got a new president coming in. And of course, there's a lot of talk. You probably hear it on the cable news about tariffs and other things that are occurring, right? May occur. And of course, we don't know how much of it is negotiation versus in reality, if there will be increase in tariffs. It's possible that if there is tariffs, an increase, that could actually have some impact on inflation. So that is a worry. So then you have earnings risk. Right now, today, the market has forecasted a 15% increase in earnings this year. Well, that's a big number. Any disappointment or anything coming short of that will have some impact on the stock market if there's a revision of those earnings. So right now they're very robust, which should help the stock market currently, but that could be a real difficulty. And then we have geopolitical risks. We all know about these. We got China, Taiwan. You have Russia, Ukraine. You've got Iran and all their proxies against Israel. So there's a number of those political risks that could blow up this year, and there's plenty out there. Now, fortunately, last year nothing emerged, but we don't know where that could end up going. So potential for market correction, and we're going to talk about this. We're going to look at some charts. Normally, every single year, on average, the stock market will drop over 14% from its intra-year high. Last year, we saw very little volatility to the downside. In fact, the stock market only fell 8%, which is very unusual. And so this year increases the probability that a correction will come to the stock market. And what is a correction? Technically, it's 10% or more on the downside from the intra-year or the recent high. So we'll see if that occurs. It didn't happen last year, which increases the probability that it will happen this year. And then we'll give our forecast on that. And so narrow market leadership. We're gonna have a lot of charts on this, that only a few stocks are driving the index returns. And we'll talk more about that. Whenever you have narrow leadership and it doesn't broaden out, that doesn't bode well for a continuation of a bull market. So we'll look at that. So those are the worries. And then we'll get into why we should own stocks. Well, the consumer, I'm sure all of you are out spending. Have you been out to the malls recently, spending, traveling, doing everything? How many are really spending a lot? How many wouldn't raise your hand no matter what I said? I knew there would be one guy. Okay. All right. But the resilient economy, last year, it blew away all the economists because the consumer, which is 70% of our economy, our GDP, ended up spending. And we'll talk about the difficulty of forecasting when you have that kind of a situation. We had corporate earnings. Well, we talked about the negative side. Well, the positive side is what happens if they do stocks end up reaching 15% growth rate. That would be a positive for the stock market. And then there's room for monetary policy easing. If we look at where the Fed rate is today to where inflation is and that spread, there's certainly plenty of room for the Fed to lower rates. Now, currently, the Fed is on hold. The Fed minutes came out recently, and they're not going to lower rates, but they're going to be data-driven. How many have heard that phrase, data-driven? They're going to base their future rate movements on the actual economic data that unfolds. And then there's sector rotation opportunities. We believe, and we're going to look at this, it's a good time to own maybe just not those tech stocks, those few tech stocks that did well, but there should be opportunity for some stocks that underperformed last year, and we'll be looking at that. And then, of course, we have the structural tailwinds. We got the development and the build out of AI, and that is early in its long-term outlook. It's still going to have many billions and billions of dollars in companies investing in AI. And of course, we have clean energy and infrastructure build out and things like that that are going to probably propel growth in the future. And then we have contained inflation. Even though the inflation rate came way down from its peak, it's been kind of going sideways the last few months. And that's why the Fed's on hold. They want to see where the inflation rate is going to go. And we'll look at more than that. But currently, the inflation rate is down about 2.5 or somewhere around there. And so it's still okay. But it has more room. The Fed's target is 2%. So we have a ways to go on that. So I want to recap 2024. I've been in the business, it said 35 years. We've been holding 35 years for quite a while.
5 years.
So let me say this, I'm under 40, but I'm heading there of being a chief investment officer. So I've had a lot of experience forecasting. And this year, 24, not this year, but last year was the most difficult we've ever experienced, not just for me, but almost all economists in all Wall Street forecasters. So we'll look at that and see how well we did or they did. And how many remember this, looking at this group, you probably remember the Fonz. Well, I know there's some people here. Raise your hand if you remember the Fonz. Okay. Well, when he maybe got something wrong, he couldn't say the word wrong. He'd go, rrr, rrr. So myself and all the economists out there, we were, I'm not going to say it. Goodbye, Fonz. Okay, here's Fortune. I found like 4 different articles. This was in December 24. How did so many economists get it wrong? And one of the reasons is we came out of a pandemic, which happened last time 100 years ago. So we don't have any real strong precedent in modern markets. So it was very difficult to forecast where things are going. So why were so many economists wrong? Many said there was going to be a recession. We thought there was last year. Now, we were right all the years before that because many said it was going to happen in 22 and 23 and so on. We were right on saying, no, there's not going to be a recession. But we shifted at the beginning of the year to saying, hey, we think the markets are going to downturn. We think the consumer will be exhausted and they're going to pull back in spending, which they did not. So we're one of those people that got it wrong. So what did we do? We got a little more conservative in the portfolios. And it was working until September this year. And then it kind of turned because the economy just kept going gangbusters. We'll look at that. So here is these are all the predictions. I don't know if you can see the names. Bank of America, Barclays, BMO, we got Goldman Sachs, all the big names. And this is the prediction. I don't know if does that work?
Use the
Top one. Okay, you can see that this was the highest estimate for the S&P 500 was 5,200. There was a couple that were there. That's where we had forecasted. We were right at the top with all these research firms. But as the year went on, they said we were, and what did they do? They moved all their forecasts out. This is October, the end of October. You can see where all the black ones were beginning of year. They said, wow, this economy is doing so much better. And they shifted it all to here. So what did we do? We didn't even try to guess where it was going. But where did it end up? Just under 6,000, 6888. Right there, 5,088. So that was missed by a long shot, even from the highest. You can see some of them were expecting bad years, a negative year last year. So this is all the experts. So all the experts were what? All right. We were among them, by the way. Okay. What happened? Well, we've had 2 years now of a continuation of this bull market. We ended up with over 20% return in the capitalization weighted S&P 500. And you can see it's a rare thing. We'll look at that as we go through. Now, what happened and why was the S&P 500 return so high? It was because or almost 60%, were in the top 10 stocks, AI tech stocks. They drove all the return. Now, as a portfolio manager and my other peers out there, because we own 30 stocks in a portfolio typically, it's very difficult. You can't really put more money in the big stocks because then you add too much risk. If you have 500 stocks, you can do that like an index. So what happened was it was driven 60%, and you can see that 70% of the return last year in the capitalization weighted stocks was driven by 70% of our 20 stocks that drove all that return, 70%, and 30% drove the rest. So there wasn't much less left over to eat. So almost all of it was concentrated in a few stocks. By the way, we owned a lot of those stocks. Okay, here's the big ones, the AI big tech. This is the contribution that they had as throughout the year. NVIDIA was the biggest. NVIDIA was over about 17% of the stock market return. Apple, Amazon, Meta, Microsoft, they were all what drove this particular year last year. Now, this is a great chart because this shows from the beginning since 21, but the green line up here, that is 7 stocks, which we call the Magnificent Seven. These are AI tech stocks, including Tesla, and you can see where it went. This is the other 493 stocks is the blue line. So if you didn't own these, you can see the difference between all the other stocks and 7 stocks. Very concentrated, and this is what the actual S&P 500 did based on the impact of these stocks on that. This is all the 497 other S&P 500. So it's been for several years a very narrow market, and to achieve a risk protection, it's very difficult to put more money in a few stocks because if they go wrong, they come down big. And we've seen that historically. Huh? Yeah. Well, let's point that out. What happens? Here's the Magnificent Seven at 22. How much is it down? 40%, while the rest is only down 8%. So there is the protection example if you put too much money in one area, which we don't think is prudent for any investor. Okay, so how did that impact the stock, the S&P 500? This is the S&P 500 return. That's where you have all the impact of those 10 stocks. And this is the total S&P 500 equal weight, where you don't put a lot of money in just a few stocks, but you equal weight all those stocks. And look at the difference, 12.8 to 24.9. Now, we equal weight our positioning in our equity portfolio. And our stock positioning came out better than that, about 16.5, but it still could not compete with those few stocks that drove almost all the returns. Okay, so last year, this is the volatility. How many 2% declines did we have last year? Very low. Here's the average historically. Now, it has some big time years that sway the data, but you can see the average. This is where we were the year before, and last year, very low volatility. And over here, you can see S&P 500 set more than 57 highs. You can see how many new highs were achieved last year. 57 were broke all-time records, and that's why the stock market did so well that year. So the average is right here. So we had an unusual year of stock market performance, again, driven by just a few stocks. Okay, so I talked earlier about what can happen every year. And this is we had 8% decline in this little circle. This is each year where how the dark ones is how the stock market ended up. This is what was the intra-year decline. Was there corrections? Well, anything about above here, you can see that we've been low. We were very low at 8%. The average decline each year in the stock market is 14.1%. That's why when you're investing in the stock market, you don't want to get nervous if the market tails off in a year, because it can tail off 14%, but still end up positive in many cases. So this chart really helps you psychologically and emotionally stay the course, because you can have negative years, downturns, but it still ends up positive. Now, we didn't have much of a turn this year at 8%. So we expect this to not remain that low as we come into 25. We'll talk more about that. But last year, no correction. We were expecting it. It didn't happen. Okay, economy surprise at the upside. What was the driver behind this stock market that just kept going and going? Well, it was the consumer. And what happened is that this is Citi's economic surprise index, and it says how many times did the economic data surprise to the positive side, to the good side, versus the negative side. And you can see that the economic surprise of this index kept going up and up, which drove a lot of the strong economy and also the stock market. But it was negative for bonds. Bonds were expected to outperform last year. They didn't because of this. The economy just kept doing better and better. Now you can see since then it's starting to come down so far, and we're starting to see a drop, that more and more economic data is getting mixed. And if it goes down here, then it's getting negative. But we can see that drove the economy, was surprising to the upside. And that started in the fall of this year or last year. Now, what happened to bond yields? 10-year treasury yields. They went up and up. We positioned ourselves right about here, and we were doing really well in that as of September. The 10-year yield went to 3.62, but then that economy kept surprising the upside. Inflation was not going down anymore. And what happened? Bond yields have gone up. And when bond yields go up, treasury performance goes down or flat. We ended up flat for the year in that conservative position that we took in 10-year treasuries. But that was the impact. It was this, and it was impacted treasury yields like this. Okay, good year for cryptocurrency. How many have all your money in Bitcoin? Well, had a good year. And you can see that it's up significantly, 52%, and then Ether was up 38. This is, I don't invest in this because it's what we all think it's worth today. Everybody in this room, whatever we think it's worth, that's what it's worth. It has no utility. I'm more of a Warren Buffett type guy. I want to see something that's being built or sold. But right now it jumped up, and you can see that it's tailed off recently. Now, what will happen to this if the market goes into a downturn and there's a correction? The liquidity will be taken from Bitcoin, these two. So whenever we've seen the stock market fall, typically Bitcoin isn't going up. It actually goes down about 1.5 to 2 times the stock market. Why? Because it's a source of liquidity that people want to grab money and maybe put it and buy stocks at a cheaper price. So if we do get a downturn this year, my forecast is that will fall significantly more than the stock market. Unfortunately, it would be nice. I'd probably be in it if it was a hedge. In other words, when the stock market's going down, it's going up, but it hasn't proven yet to be able to do that. So we'll keep an eye on that for all you cryptocurrency people. All right. So here's the big one. Where are we going this year? That was last year, but where are we going this year? Well, you can see that back-to-back returns of over 20% are very rare. We had one back-to-back. You've had a few, but here you can see all the way back to 1930. There's not too many years where you get back-to-back 20% returns like we achieved last year, right here. So what does that mean? The probability of another strong stock market is not high, because it very rarely goes 2 years. Well, it can go 3, but it's very rare. You can see there was one period that it went 3. Okay, so here's another chart. Make sure I didn't miss anything. Okay, this is the valuation. We talked about the stock market, how it's valued today. This is the 30-year average for the price to earnings ratio. That's price divided by earnings. And by the way, it's forward earnings. Remember, we talked about a 15% expectation. So that is very high, which should keep this down. But you can see historically, when you get up into this range, one standard deviation above the normal, above the valuation average, you can see that markets tend to fall. What is it? We're priced up in here around 22 times forward earnings. What does that mean? That means that the stock market is priced to what I would call perfection, meaning there's no error, room for error going forward. Everything has to come to pass or exceed it for that to continue up. But there's not a lot of room for stocks to be valued anywhere higher than it is already. So this is something we're watching, and this makes the stock market more vulnerable as we go through this year. Now, with this particular PE ratio, what historically would be the normal return based on PE ratios, and this is forward. This isn't looking at today or backwards. This is forward earnings. You can see very little return, positive maybe a few percent would be the expectation where that diamond is from here, which means where the valuation is today, historically, that would mean there's not much upside. Very single digits are probably the normal, as you can see there. So the outlook is not really good based on the valuation of the stock market today. Now you can see here that this is all the times, the year 1, year 2, the returns, and then year 3. The average return is 5.2% once you've had 2 back-to-back strong bull market years. So we're into the 3rd year. The odds are, again, based on valuation, based on where they have the earnings expectation, that the stock market will have some difficulty this year, and we are not looking for double-digit returns for 25. And we'll talk about that. Here's a couple indicators. How many get an investment stock newsletter from the professionals? Anybody? Nobody gets it? He gets one. So there's hundreds and hundreds of professionals putting out their forecasts and what stocks to own and things like that. But you can see, how bullish are they? Well, that's how bullish they are right now. Now, this typically, if they were bearish, it would be down here. Here's the 0 line. So many stock professionals are bullish, but this is a contrarian indicator. And what does that mean? When too many people get bullish, the odds of a disappointment increase. So when we see it this high, you're going to say there could be some vulnerability to the stock market. Another one is the investor. This is consumers. Well, that's off the chart. How many are bullish? We haven't seen, this is record high. How many retail investors are bullish? That is a contrarian indicator. Typically, when you get that high, there's going to be something could go wrong. Now, if the stock market, the economy keeps growing, consumer keeps spending, companies keep beating expectations, then we're okay. But if any disappointment, it could make the stock market vulnerable this year. All right, where are bonds going? 25. Well, we've seen this is the favorite inflation gauge for the Federal Reserve. the PCE. And you can see it's been heading down from its peak up here, and it's been heading down. But see, these last few months, it's gone sideways to slightly up. This is why the Fed is on hold right now with interest rates. They've done 50 basis points and they've done 25 basis points. So they've dropped the rates 1%. But you can see that it's going sideways at this moment. We believe, and we'll talk about this, it's going to continue its march down as we move forward. Now, the wild card there is President Trump's tariffs. What kind of impact could that have on the inflation rate? But he's aware of that. I think it's more negotiation. And so is there room for the Fed to continue to drop rates? This is the CPI versus the Fed policy rate. This is where the Fed is. And you can see there's a big gap between where the CPI is. And if this continues down, there's plenty of room to have the Fed drop rates even right now where the inflation rate is. So that's positive for bonds. Another positive for bonds right now is that the yield on bonds just surpassed cash. You could own a money market fund and get 5%. So there's been a great return at low risk or no risk. However, the bond yields have risen and now they're higher than the short-term rates, which means that it's better today, in our opinion, historically too, that you begin to move out from cash and go more into longer duration bonds so you can get the appreciation if rates begin to drop. All right, here's the Fed, and they're still dovish longer term. This is their long term. This is where they think in 27 rates will be 3%. Nobody in our business knows where the exact neutral rate is, where they're not dovish or hawkish. They're kind of in the stable center. We're not sure where that is because everybody's right now looking at data economically as that comes in over the next several months to see where it goes, like the inflation rate. But you can see the Fed has got plenty of room to come down. And they're expecting 2 more, if things are status quo, 2 more drops in this year in 25. So that's positive for bonds. The other thing is, well, how about bonds relative to stocks? And this is the equity risk premium. And what is an equity risk premium? That's what you get paid for taking more risk moving into the more volatile stock market. And there's a lot of measures. There's 4 different ways to calculate this. But right now today, we're down almost at 0, which means there's not much, because stocks are so valued relative to the bond market's yield right now. And that's even come down probably below the 0. Means there's not a lot of reason to take more equity risks today based on this gauge. So that would be positive for the bonds. Here's another one. I like this particular graph. The top one I circled is what is the average annualized return in the past 7 Fed easing cycles. So we've already dropped 3 times, 50, 25, and 25. So we're in a cycle where the Fed is lowering rates. We just looked at the chart that showed they're probably going to continue to lower rates. And the average bond return when they're in this easing cycle, lowering rates, is 16.7. Now, the stocks did better. But the second one is what happens if something goes wrong in the economy. And you can see how bonds outperform stocks dramatically in that situation. So what does this say to us? The bonds, where things are today, are a win-win situation either way. We're in a lowering rate cycle with the Fed, and even if we don't go to recession, it still does pretty well as a lower rates. A 16.7% return is not bad for very lower risk compared to stocks. All right, this is a lot of bars here, but I put arrows on the bond market. This is the higher the bar, the more volatility or risk. And it shows the Morningstar US total US market, shows the developed markets, internationally and US, and then of course emerging markets. And the blue is which I highlighted, is the bond. So what does this mean? That bonds today, where the yields are today, are going to lower the risk of your portfolio. And so we're positioned that way. We were most of last year too. We were early, but we think this is the year that our positioning gets paid off, because we expect markets to correct this year at some point. Here's another one: home affordability, maybe of children that want to buy a home. This is not looking good, and because of the higher mortgage rates, but this is the home affordability. And the higher this is, the easier it is to buy a home. If you go below this number, right where it is today, not too many people can afford to buy a house. That's why the housing market is really in a recession. And as long as rates stay where they are, it's going to be difficult for the home market. May not be a good time to sell today, even though prices are higher. They haven't come down. And a lot of that reason is because there's limited supply of homes on the market. And there's demand, but are people willing to pay the higher mortgage rates today? And the answer is the affordability cuts out a lot of people. So the housing market right today is going to probably continue to struggle unless the Fed starts lowering rates, which we think they will sometime this year. Okay, this is the big one. What are we forecast? Remember, we were lousy last year. Okay, I'm just giving that. I was roar. Okay, along with about everybody else. Okay, I'm not feeling too bad. All right. So this is our outlook, and it's only good today. Anybody get that one? Okay. So we expect the economy to continue to cool off. It's been hot. We do, but it will be supported by corporate investment, technology, infrastructure, and but we do believe that at some point this year there will be a reemergence of recession talk. It's not there right now, although I just read that Goldman Sachs is now talking about a recession potential. Just read that this morning, but I wrote that before that came out. All right. So there probably will be a reemergence later in the year of potential recession. Consumer is the key. Can the consumer continue, which is 70% of our economy, can they continue to spend? A lot of it came from government money that was given to them. Well, that's dwindling down. Savings from the pandemic has dwindled down. But wages have been upholding. So wages have been good, and they're upholding the consumer right now. The question is, are they going to pull back this year? And if they do, all the forecasting of a 15% earnings growth will go out the window, which will put a lot of vulnerability in stocks. So the stock market, we're predicting the stock market volatility increase, volatility rises, but we believe it's going to trade in a range, kind of a 0 to 10% range as we head throughout this year. We do believe that underperforming areas of the market are going to benefit, such as healthcare, energy, consumer staples, and utilities. Utilities did well. We don't see tech falling off unless we go into a correction, because they have real earnings and they have real revenues. This is not like the tech bubble back in 2000 when everything went down, because the AI companies are really driving real returns. They have real earnings. They have real revenue increases. However, the growth rate is going down because you can't keep growing at the same rate when you're that big. So that will tail off. So what does that mean? Other sectors of the market will probably perform equal to the tech stock. The techs will not have the big advantage they had the last several years as we go forward. So we're looking for opportunities there. So that we believe the inflation rate sometime this year will begin to tail off. Remember, it's been kind of going sideways to slightly up. We believe it will get back in path and start heading down, and that the Fed will restart. They're on hold right now. Will restart their lowering rate campaign. That will begin to start again, and bonds prices will begin to rise, because when rates go down, bond prices go up. And we own a position in our portfolios in intermediate treasuries and 7 to 10-year treasuries. We expect that to do very well this year. It was flat last year, but we expect to make it all back this year if we're right on our forecast. So bonds rally, stocks go negative. We expect a correction this year, but we still expect after the correction that it will work its way back to somewhere between 0 and 10%, most likely single digit for this year. That means that bonds could be even double digit if we're right on the direction of interest rates. Now, if there is a correction or something happens, a geopolitical event or disappointment, bonds will be the beneficiary, especially treasuries, because that's a flight to safety. And if there's any need this year for a flight to safety, they're going to go back into the 7 to 10-year treasuries, which should push up those prices as we go forward. Of course, we always have, again, the geopolitical wild card. We talked about that, whether it's China, Iran, or anything goes wrong overseas, or even with our own country. Now, I added something this year, and there's a reason for that, is assassination. That's a high probability. We have already had 2 on President Trump to elect, and that's out there. A lot of people want him dead. So, and a lot of crazy people are out there. Hopefully they can protect the administration and so on. But I added that because, normally you don't ever see that going on. Abraham Lincoln, there's been a few, but I think that's a risk that's out there, but it's a wild card. But I put that in there because that could, if that occurred, if something happened to our president, that would definitely cause the stock market to crash. And so these are some of the wild cards. You can't predict geopolitical. All you can say is the probabilities are higher as we move forward. Okay, that's it.
Thank you very much, Tom. We always appreciate your balanced approach to analyzing all of this for us. With that, open up to any questions. Any questions in the room? We'll start with you guys. Any questions whatsoever? I saw Herman first. Sorry, Howie.
Well, we
repeat the question.
Yeah, the question was, what percent should you have out of stocks today, as from 100% invested to being more conservative? I would say exactly where we are in our portfolios, which is 25%. Now, if something went down, we may increase that, but we're waiting to see, if what we believe is going to happen unfolds. If we start seeing signs of weakness, we may increase that. But right now, I'd say 75% invested in the equity target. But I like now in 7 to 10-year treasuries for 25%. I think that's a good hedge at this point, because that particular segment will go up if any vulnerabilities or anything hits the stock market. We're going to see 7 to 10-year yields rally. No, the only caveat to that is if inflation took off. If inflation just surprises to the upside, then you're going to have stocks coming down and you'll have bonds coming down. But still, in that case, bonds are good. We've seen it already this year in a few down days. Stocks go down much further, even with rates rising. We've had a move up in rates, but I've noticed that the 7 to 10 years holding out much better to the stock market. So either way, you could have back in the 70s during high inflation. Remember, we had a negative bond market. We had a negative stock market. It doesn't happen very often, but that is a possibility, but it's still better than being 100% stocks. So where the valuation is today, where the earnings expectation is so high at 15% for price for perfection, we think we're positioned properly as we head into this year.
You're saying 25% down, 75% stocks.
We have well, Eric can address that, but we have, depending on what portfolio you're in, we have a number of risk levels and so on. We think that in the equity side, 25% in the equity component for bonds.
So we take the time to go through every single account that we're managing to determine what is the baseline mix between stocks and bonds. So the question was, if you are normally invested 100% in stocks, like this guy over here, what would be an appropriate amount to move, given the current environment? What would be the appropriate amount to move out of stocks and into bonds? And Tom's answer is 25%. So what that means for somebody that's, say, 60% normally invested in stocks and 40% normally invested in bonds, you take 25% of the 60 would be the answer to the question, and that should get moved over to bonds. And that's something that we've already done. That answer your question?
Yeah, so we're positioned already where we think we should be for going into 25. And of course, what would we do if the stock market comes down and bonds rally? Well, that would give us the option to go back in and sell out the bonds and go fully invested in stocks. And that would be the plan. The plan would get to be 100% stocks, but we don't think at these prices, it's the time to do that. Right now, bonds are undervalued, stocks are overvalued. But if that inverts, we would definitely have the opportunity to now redeploy that 25% in bonds back into stocks. And that's the plan. That's the plan.
And to be clear, in that scenario, for those that are, say, 60-40 as a baseline, as a normal, environment, and they're now, more 45-55 or so, we're not saying we would go 100% into stocks on their entire account. We would move it back to the baseline of 60-40, back to that original target of 60-40. That make sense?
Yeah. So and what our whole goal here is to protect money, grow it and protect it. That's what our objective is. So that's the way we're designing the portfolios, is to grow it and protect it.
Howie, did you have?
Because of these horrendous fires in California and other big weather disasters in South all over the country, I expect that the insurance rates are going to go up all over the country. Does that have any effect on the economy at all?
Well, the question was, with all the fires and all the natural disasters occurring, weather pattern changes that are going on, will that have some impact on insurance? It's definitely going to have impact on insurance prices. And if they're paying more for insurance, they have less to spend for other things, which would impact the economy. But the area that's there, a lot of the people there in these homes so far, I think, that have been burned down are very wealthy people. Will that have an impact on them? Probably not. But for the others that are there, and the impact of the money I'll tell you who's going to be paying for it. We're going to be paying for the rebuilding because there's not enough insurance to cover all the losses. All the insurance companies can't afford it. So there's a safety net. I wouldn't want to be in the state of California. You're not moving there, are you? Just look at the golf course. We can go out and play right now.
And at the same time, the ice rink is open too, so we're skating.
Yeah. By the way, I'm a hockey player, so.
Okay. Any other questions in the room? Dana?
Yes, so connected to the natural disaster a little bit here, do you consider personal debt and corporate debt, business debt into any of your outlooks that you worked on?
Yeah, I mean, that's not what I would call a major component, but we look at it, and right now corporations are in very good shape. Their balance sheets are excellent. The consumer, which is 70% of the economy, that's getting weaker. Especially, there's different areas of income and so on. The lower incomes are in trouble. And that's where the most problem is right now. If that starts to spread to the middle class, then that could be a problem. We're watching that. But we're definitely seeing kind of financial crisis levels for the lower income.
Yes.
Well, gold has made a huge move. It's pricey. So how much upside is left? I'm not a gold expert, but it is a place to put money. I'd rather have a stock that pays a dividend, because gold doesn't pay a dividend. And it's kind of like, do you own Bitcoin or gold? Some are saying no, the gold's the old thing. Now you got to own Bitcoin. That's the new thing. It's not my area of expertise, but it's moved already a lot. And so is it towards its peak? You know, we're hit all-time highs. You know, is it going to continue? How much is left? I'd say there's not a, but if we go into a massive crisis, then it will do well. But I wouldn't buy it here unless you see something happens, maybe the day a major crisis happening, go and buy some more. But I wouldn't buy it here, personally. It's not in our universe. Gold. The what?
Bitcoin. What is it? I don't even.
Oh,
Question is, what is Bitcoin, and can you explain it to us?
Yeah, it's what they call the cryptocurrency, and it was developed by some guy that we don't even know who he is. They haven't discovered who he is, and it's all algorithm based. And it's so when you buy Bitcoin, you get a serial number, and that serial number attaches to what you own, how much you own. And it's not on just one computer or at one central bank. It's on thousands of computers, and they all have to align to mark the price to where it is. So what it is, it's like currency, but there's nothing physical. It's all in the internet. That's what it is. Now, how much of Bitcoin is actually being used today for buying and selling things? About 4%. The rest is all speculation. The reason is because the price is too volatile. You can't have a currency that's, you know, up 10% today, down 20 tomorrow. So it's not good for currency. There was an island in Asia where they had converted all to Bitcoin. Well, they got wiped out because people were selling, and of course, Bitcoin just not that long ago crashed. Well, I'm selling my goods to them, and then I get Bitcoin. Well, unless you convert it to US dollars quickly, you're at high risk. You can be a winner or a loser. So there's too much volatility. So, and it's the value of Bitcoin is what we all think it's worth today. So, not just us, but all the investors out there, speculators, what they think it's worth, that's what it's worth. There's no utility, there's no income, there's no business. But President Trump is kind of saying, well, maybe the government should own some of it, which has caused the price to go up. It's starting to come down a little bit now. It's a high risk investment. Yeah, it's fictitious. Yeah, but it's what we think it's worth. Yeah, you can sell it. There's brokerage firms now. There's now even exchange traded funds, BlackRock, the largest fund manager in the world, and a number of them have Bitcoin ETFs where you can buy it, let them worry about all the serial numbers. And then you just buy it and sell it, and whatever the price of Bitcoin is, that ETF moves along minus their fees. So you can buy it today in public markets. Now, that wasn't true a few years ago, but the SEC allows now a few companies to launch Bitcoin, Ethereum type funds. So it's not something that I recommend, but if you want to throw a few dollars at it, go ahead.
And to be clear, we cannot recommend it.
There we go.
It is so speculative today that the regulators prohibit us from weighing in on buying or selling Bitcoin. So we can't help you buy it. We can't give advice on whether or not to buy it. So what Tom is talking about is just what your options are out there, but we are not able to help with that in that department. Good question.
Well, now today, there's cryptocurrency brokerage firms where you can send your serial number and they'll give you cash or whatever, turn it to US dollars or whatever, some other options. But the easiest way to buy it is through an ETF. It's like a mutual fund, exchange traded fund. You can buy it there. BlackRock iShares. You can go to iShares, one of the largest fund managers in the world. They have a Bitcoin ETF. That would be the safest, easiest way. Because some people get hacked. They lose their serial number. Well, what happens if you lose your serial number? well, you're dead in the water. In fact, there are some people back when it was only a few dollars that had the serial number on a computer. They thought it was worth nothing. They threw their computer out. So somewhere in a dump is a PC, maybe with $1 million with a serial number in it. Now they have cold storage, hot storage. Cold storage is where you take your serial number. You don't keep it on your computer that can be hacked, but you download it to a physical object off the computer that no internet access can get to. And I'm sure BlackRock and the ETFs are using what is called cold storage for a lot of it. So they don't have, because North Korea is pretty good at stealing Bitcoin. That's how they're getting a lot of money, is stealing Bitcoin serial numbers to get the money. This, if you're 18 and above to 18 to 30, go for it.
Not a recommendation.
Not a recommendation.
What about the national debt? How does this factor in?
National, that's a good question.
See,
He's asked about the national debt. How's this impact? Well, right now we can afford to make the interest payments, although it's a bigger portion of our total budget. But it's at a point where there was just part of the reason Treasury yields went up this week was because there's a big sale of the government selling treasuries. And are there buyers out there? Well, you have to keep raising the yield for buyers to come in. And so they're saying, well, in the future, how's that going to impact the treasury market? And it could have some impact. I think it's keeping yields a little higher than normal. But we think that's going to turn around. In fact, the deficit, I think, has starting to make a corner. And I think Trump might be able to do something there. He knows how to manage debt, supposedly. But it has an impact on definitely treasury yields and our overall use of money for other things. The thing about our debt today is we're not in a crisis. Well, what would happen if we go into a crisis and we already have a huge debt, like World War II? When things like that happen, your debt goes to a record high. Well, we're already there. What would happen in the United States if that occurred? We have another big crisis and it costs money. So that's a vulnerability as we move forward. We're watching that carefully.
Any other questions? If you are watching online, I see you out there. If you have a question, feel free to post it in the comments section or shoot me an email directly. Would love to bring that to Tom. We'll just maybe just another minute or two here. And if you're watching in the recording, of course, you're welcome to reach out. On the website, there should be a button below this video where you can submit a question, or you're invited to email me directly as well. We'd love to circle back with you. I don't see any questions online. Any other questions in the room? Otherwise, we can get some lunch going. Going once. All right. Well, let's wrap it up then. So with that, oh, we got one more. I love it. No, don't apologize.
Better on the Vikings than on this. You get back, I can go to bed,
No, give a call to Sam Darnold, see what kind of frame of mind he's in. And then once you do that, let us all know. And we'll bet with you.
If you're interested, going back and touching up on any of this, the recording will be on the website here this afternoon. We'll also have a summary. Each of you in the room has a summary. And then, like I said, you can ask a question if you do think of any other questions after you leave here today. Again, we love taking questions. We want to make sure that we're providing as much clarity into what we think is going on as possible to help you guys make better financial decisions. So you can save the date. We are scheduled for our next monthly update. So we do this presentation every single month. We're going to be online only next month, scheduled for Thursday morning, February 20th. That'll be on the website here in the next few days. If you're not aware or not joining me, I do start off my week with a short summary of what's going on in the market. So 9 a.m. Central Time, Facebook, YouTube, LinkedIn, everywhere. Do a short update, kind of stay in touch in between these more formal monthly updates. And if you're not doing that, or I'm sorry, if you're not able to join me live, I do send out an email at 2:00 Central Time Monday afternoon with a link back to that recording, and then some other details in that email as well. So if you're not getting that email, you can subscribe at our website, which I'm sure all of you are aware of. So with that, I'm going to wrap us up. Take one last look for any questions. No other questions. So number one, thank you all for coming out here today on this cold day. Appreciate you taking the time to be here. Tom, thank you very much as always. We appreciate you so much. That will conclude this month's monthly capital update and outlook, as well as our 2025 outlook. So thank you guys,
Thank you.
everybody.
Like that. Got two big points. I'm sure I'm not very tough. But first, put it on film. And. Spread the car drive or what? But, yeah, you have to take it active. John Dixon. I believe.